What are your clients worried about right now, and what are you telling them?
Well, obviously, the most topical issue now is the regulatory tightening that's been taking place in China. We've seen very, very dramatic price action following the tightening in various sectors, really related to social social parts of the economy. So that's really been front and center in investors' minds. Of course, Jackson Hole is topical as well, and concerns over the potential timing and magnitude of U.S. tapering is something that is on the back of investors' minds. But really, I think the issues now are China regulation and then also the rise of the Delta variant and how that might be affecting growth outlook. Those are the two key issues that investors are focusing on.
On the China crackdown, despite those concerns, we continue to see turnover volume in China pretty high, as this GTV chart on the Bloomberg shows. Are we seeing investors chasing after some cheaper stocks there? Is that a good idea at this point?
Well, there's definitely a mixed amount of interest on China currently. There's a few points to make. First, there's a pretty wide bid-ask spread in terms of the investors we're speaking with, some of whom are finding it very difficult to engage in China, taking a much more bearish view. Others looking at this as a significantly discounted deep value opportunity for a number of stocks, particularly in the areas that have been most affected by regulatory tightening. Our views are to prefer the onshore A share market to the offshore H and ADRs for a variety of reasons, but mainly because we think that the onshore A share market will be less impacted by some of the regulatory tightening that's taking place because of the different compositional mix of sectors and a variety of other reasons. So we certainly are seeing this type of differentiation within the market. Secondly, there are clearly different opportunities within the market. Some of the sectors that are more socially oriented are in the limelight of the regulatory tightening. Those we think will still remain under pressure despite the fact that some value is emerging. But other areas that have the full backing of policy support, particularly in areas like foundational technology and decarbonization, those areas we think actually have a very bright future ahead of them. And that indeed is where some investors are looking right now in terms of where there's more structural opportunity.
Right. So this again goes back to, I guess, pouring through, the 5-year plan and the readings of Xi Jinping, right? So would you be avoiding all consumer-facing companies, business models, and I guess avoiding any company that is in the business of collecting data?
No, I think that's too extreme a conclusion. I think that really what is called upon now is a much more nuanced approach to China. There clearly are areas that are under an ongoing regulatory tightening, and there will likely be a cloud over them, even though there may be some value that's emerging once we find a new equilibrium. But even within that, and in the area that you've mentioned about consumer, there are opportunities. I'll just give sort of one example. There's clearly been a tightening on property which has been going on for some time, because the key areas that are central to family and household formation, which would be education, property, and healthcare, have all come under varying degrees of regulatory tightening and scrutiny. Within the property market, however, there are certain areas that will continue to do well. There's a much described phrase of properties for living, not for speculation. So, for example, property management companies will continue to be and do well, we think, because people still need to be living in the houses and need the services associated with those. So I think if you take a much more sort of partialized and nuanced approach and really drill down into areas that will be less immediately affected by the continued range of regulatory tightening, that those can be some opportunities that present themselves.
Of course, we're watching the RBNZ, and it's just such a fascinating, dramatic story, right? An over 1% drop in the Kiwi with just one COVID-19 case detected there, snap lockdown, and now rate expectations falling from 100% to 60% within just the last day. Do you extrapolate from this that there's an added risk profile of economies that are dealing with Delta in this way, rather than a lot of the other economies that are living to learn with it?
That's a very good question. I think the single answer is yes. But to maybe expand upon that, I think what we're seeing is a delayed time in terms of the projected recovery of economies to something like their pre-COVID activity levels. And I think in Asia, there's a particular challenging intersection of events, which is that the very success that many economies have had in terms of preventing the spread of it have meant maybe a bit of a lax approach towards deploying vaccination. And so you've got the combination of a more virulent form of the virus, obviously the Delta form, happening at a time when economies are less protected by the percentage of the population that's been vaccinated. We see this a lot in South Asia, whether it's Philippines or Indonesia, et cetera, less so in North Asia where vaccination rates are rising. Here in Singapore, if you look across the entire region, Singapore is actually the best in terms of the percentage of the population which has been fully vaccinated. So I think you've got a variegated story, and that indeed sets up some investment opportunities looking into next year because you can have this staggered pace of recovery. And I think the market may start to trade that sequential change in the outlook. And that may be one of the themes that starts to emerge as the second half deepens and we start to look into 2022.
And Tim, another theme that's been emerging, the worsening outlook for the chip industry. How vulnerable are markets like Korea or Taiwan given their heavy weightings for Samsung and TSMC?
Well, actually, I'm really glad you asked that question because there's a big debate in the market on this, and we're actually taking much more the constructive side of this. In fact, we just had a corporate day for Korea, and have published some reports on the feedback from both Samsung and from Hynix, which, of course, are the two largest tech stocks and chip stocks in the Kospi index in Korea. And we take a much more constructive view. We think that the demand supply outlook for various types of chips is better than the market is currently fearing. There still is going to be an ongoing recovery in terms of demand. There's increasing densification of chips across a variety of different activities, whether it's in autos, the Internet of Things, data servers, cloud, et cetera. Supply is still constrained. There's going to be some challenges in terms of the migration of greater or finer geometries, which will reduce the overall yield. So we're much more constructive on the overall demand supply outlook and consequently for pricing. I think that where the current, the market overall and some of those stocks in particular, what they're pricing gives quite a skewed risk reward profile to the upside. So we are positive. We're overweight on Korea. We're overweight on Taiwan and think that the market is unduly concerned and is sold off too much and therefore it presents an opportunity to reengage.